So I am honored to introduce our next speaker, who also needs no introduction, CFPB Director Rohit Chopra. Director Chopra is also a member of the board of directors of the FDIC and the FSOC. Prior to the FDIC, prior to the CFPB, he served as a commissioner at the FTC, Federal Trade Commission. Director Chopra has spent most of his career looking after American consumers and honest businesses to make sure that they have access to financial products and services that are fair, transparent, and competitive. Prior to his government service, Director Chopra worked at McKinsey, a well-known global management consulting firm, where his work was focused on financial services, healthcare, and consumer technology sectors. Director Chopra is not new to our conference here. He's not a stranger here. He has been with us regularly. Last year, we had a fireside chat with Tim Mazard, and another fireside chat before that as well. At this conference last year, Director Chopra made an announcement related to mobile payment products and services provided by big tech firms. This year, his talk will focus on the future of open banking. And it is so wonderful to have you back here today, Director Chopra. We are grateful for all your support for our FinTech activities here. And here is Director Chopra, CFPB Director.
Well, thanks, Jalapa, and thanks to everyone at the Federal Reserve Bank of Philadelphia for organizing today's event. Big thanks to President Pat Harker for all of his service to this region where we both call home and to our country. Today, the Consumer Financial Protection Bureau has finalized the Personal Financial Data Rights Rule, which implements an authority enacted by Congress in 2010 in the aftermath of the financial crisis. The rule will provide more freedom, promote decentralization, spur greater competition, and more. It will be an important step toward ensuring that the principles embedded in the fabric of our financial system, dating back to the earliest days of the Republic, are reflected in the digital era. I'll start by explaining some of the problems we're looking to solve with this rule. I then want to describe how the final rule works, and I'll conclude with some next steps to continue moving open and decentralized banking and payments forward in the United States. As always, my remarks reflect the views of the CFPB and do not necessarily represent the views of any other component of the Federal Reserve System. In today's economy, problems in banking are similar to problems we see in other sectors. Rather than innovate on providing the best products at the best prices, at the best service, we find that companies have found new ways to boost their bottom line. For example, rather than constantly create a better product, we see innovation on how firms can make it harder to cancel or switch. Rather than advertise the true price up front, we see mysterious junk fees pop up later in the process. And instead of making things simple to work across different brands, we find ourselves buying proprietary plugs, switches, and other accessories that only work with specific products. These types of issues cost consumers billions. They raise barriers to entry for firms that don't yet exist and come with a lot of problems. When the Federal Reserve started to raise the target Fed funds rate in 2022, the nation's largest financial institutions were quick to hike rates on loans, but many barely budged when it came to raising rates on depositors who were saving. Switching a bank account or credit card or any financial product often involves the risk of screwing up an auto debit for a bill or incurring an unwanted fee. People are even warned that canceling an account might hurt their credit score and their ability to get another loan. So it's no surprise that for millions of people across the country, they're still using the same credit card that they first got when they became an adult. I'm embarrassed to say it, but I'm one of them. There's other problems too. Young people start off adulthood with a lousy credit score, if they can even get one at all, because you need a long credit history to get a high score. The same is true for new immigrants and others with little else on their credit report. And since lenders want an automated way to evaluate you, it isn't always easy to prove that you're a good credit risk. When it comes to making payments online or at a store's checkout counter, the market is rife with monopolistic practices that enrich incumbent networks at the expense of consumers, businesses, and creators. The results of this are that you pay more for loans and you earn less on your deposits. Fewer people are able to get competitive and affordable credit. Businesses of all sizes pay more to process payments, pushing prices up. And this hurts all of us. In the US, digital technologies are totally changing this, opening up new opportunities to fix these problems. By allowing consumers to permission their personal financial data and over time making it more seamless to switch, people can more easily sign up, take their business elsewhere while maintaining their financial history. Much of the data that does take place today when it comes to sharing uses unsafe methods, like using login credentials that you give to third parties to scrape vast amounts of data from online banking interfaces. But more importantly, incumbents just don't want to lose their captive customer base. And like in other sectors of the economy, large firms often have little incentive to make it easy for you to port and share your data. We've seen how they can concoct a slew of reasons to block us from these benefits. One of the ways to best support a vibrant market is to eliminate roadblocks to competition. In the early years of the wireless phone market, switching to a new carrier was really cumbersome, requiring you to get an entirely new phone number. For those of you who remember this, you'd actually have to tell everyone about this new phone number, and it was a huge problem. The Federal Communications Commission later instituted a policy requiring wireless number portability between carriers. This dramatically reshaped the competitive dynamics, creating incentives to compete on service and price. And to make our banking and payments market more competitive, it needs to be open and decentralized using a common set of data standards, free of powerful gatekeepers and middlemen that can impose their own private regulations and extract fees. Over the last few years, we've been working with players across the ecosystem to sketch out what open banking in the United States should look like over time. By connecting consumer transaction data, payroll data, credit reporting data, retirement and investment balances, payments information, and more, we can accelerate that progress that the U.S. is already making. We closely studied the experiences with data sharing in other sectors, like in healthcare and in open banking frameworks in other jurisdictions. One foundational aspect is to ensure that incumbents can't block consumers from controlling and porting their information. In 2010, Congress enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act. Section 1033 gives consumers new rights to access their data in a standardized format subject to the rules of the CFPB. And since the CFPB never finalized any rules, it was essentially a dead letter. Our final rule today is late, but it's a significant rule using this dormant authority. Here's how it works. If you're a consumer who uses a checking account, credit card, mobile wallet, or more, your provider holds a lot of your personal information. They may have records of your recent transactions, account balances, upcoming bill payments, and information needed to initiate payments. If you want to use that information to make a payment, apply for credit, or switch banks, your provider might throw up roadblocks to keep you from leaving for a competitor offering you a better deal. Our rule prevents companies from doing that. That means you can more easily walk away from mediocre products and choose financial institutions and others that offer higher rates for your savings, lower rates on loans, free access to your paycheck before payday, or ways to more effectively manage your finances. Under the rule, if a consumer chooses, they could allow mortgage lenders to use data from their checking account to look at their income and expenses in the underwriting process. This data could supplement or even supplant the accuracy of traditional credit histories and help more people obtain credit on better terms. Over the long run, this could reduce the system's dependence on opaque credit scores. To take another example, the payments infrastructure in the US has long lagged behind many other developed countries. By giving consumers the ability to more easily use secure payments information, we can create more options to make payments and facilitate what is sometimes known as pay by bank. This has the potential to make more payment options like ACH and FedNow more mainstream for everyday purchases. This could also benefit merchants who face high fees to accept payments through Visa, MasterCard, and other incumbent networks. Some merchants have even developed plans to incentivize payments through these alternatives through cashback, discounts, and rewards. Cash flow underwriting and more intense payments competition are just two of many of the use cases for consumer-driven data access. At the CFPB, we believe that products and services powered by this data should continue to improve household finances for all, and it can even improve monetary policy transmission. But what if companies are just pretending to offer you a competing product to bait you into sharing? What if they really just want to exploit your data for other purposes? We learned a great deal from the experiences in other jurisdictions, and we knew that putting in some meaningful limitations on how permission data could be used was critical. The rule puts in place strong privacy protections. It's pretty simple. A company that ingests consumers' data can use that data to provide the product or service the consumer asks for, but not for unrelated purposes the consumer doesn't want. The personal financial data rights rule says that consumers can authorize consumer companies to access their data, but those companies then need to act on behalf of the consumer when they access it. That means companies can't offer you a payment product that uses your data, but then use your data against you by feeding it to personalized pricing models that charge you more for an airline ticket or other service. That's not what you were in the market to get when you shared. Similarly, if you authorize sharing your data with a company so that you can get a cheaper loan, the data needs to be used to provide you that loan, not for something else. And it doesn't matter that the company has included all sorts of legalese and fine print that you don't have any practical ability to reject. Our rule also means companies can't offer something as a pretext to collect data in order to sell it or use it for targeted advertising for a whole other purpose. The rule allows companies to use data to improve the product or service the consumer requested, consistent with the goals of jumpstarting competition. But the rule is designed to ensure that open banking does not become a new data pipeline that fuels surveillance-based pricing or other manipulative mischief. Our rule also recognizes that the data is highly sensitive. It can be a map of your mind and what you seek to purchase. And there are basic protections and rights that should go along with that, with accessing that. Specifically, the rule ensures that data is collected and used minimally, stored securely, transferred accurately, and deleted when it's no longer needed or when the consumer revokes access. And critically, the rule also strengthens protections by accelerating the shift away from the industry practice known as screen scraping. Screen scraping is still a common but risky practice that typically involves consumers providing their account usernames and passwords to third parties who use them to access data indiscriminately through online banking portals. With screen scraping, there are risks of overcollection of data, inaccurate sharing, and the spread of login credentials. With respect to implementation, the law asks that the CFPB prescribe standards through the rules, but it also asks that we make an effort to avoid requiring a particular type of technology. I was particularly fixated on these provisions. We know that technical standards are critical to make sure that a system is open and interoperable. And without these standards, each incumbent could create its own set of complicated hurdles. And rather than micromanage the specifics of open banking, the rule sets out an architecture for standard-setting bodies to align on technical standards. Those organizations can seek accreditation from the CFPB, but only if they have a structure and process to develop standards in a fair, open, and inclusive manner. This approach will allow the standards to evolve over time as technology and market needs change. But the process can't be rigged against challengers or incumbents or the public. Standard setters must reflect the full range of relevant interests, incumbents and challengers, big and small, consumers and firms, and ideally would also represent the perspectives of firms that don't even exist yet. In June, we finalized a rule outlining the qualifications for entities to become recognized, which can issue standards to help companies comply with the rule we announced today. While we finalize this rule, there's a lot we all have to work on together in advance of the early 2026 deadline for the largest financial institutions to comply. Here's a few of those near-term items. First, the CFPB is working to prioritize reviewing applications by standard-setting organizations. A few weeks ago, we posted the first application for recognition for public comment and are working rapidly to evaluate the application. We're looking to make sure that applicants meet the standards for recognition outlined in the rule, and they must be ready to show that they can set up the right protocols to develop technical standards in a fair way. Second, the CFPB is continuing to be in constant communication with other regulators to advance open banking. The rule makes clear that when consumers authorize companies to obtain their personal financial data on their behalf, these companies are not acting as service providers to the financial institutions holding the consumer's data. Those companies are acting on behalf of the consumer. We are working together to ensure that incumbent fintechs and banks do not engage in tactics to choke off potential competitors. Third, the industry must update industry-controlled rules on payment networks. In the last few years, the CFPB has repeatedly expressed an urgent need for payment networks to ensure that their rules make sense for the modern age when it comes to errors and fraud. Many payment network rules help to make recoveries from merchants, other financial institutions, and other parties that erroneously or fraudulently receive funds. The pandemic and the rise of more digital payment apps has added new complexity to this. I appreciate that many in the industry would like the CFPB to solve this for them, but these are private network rules. The governing bodies of those private networks need to address this rather than just deliberating forever. Finally, the CFPB will be developing an updated roadmap for the next set of rules to advance open banking. This first rule today covers a wide range of data, especially on payments and transactions. I'm now considering a number of other use cases, such as how to reduce costs and complexity when it comes to originating mortgages. During the rulemaking process, there were a number of other issues raised, such as the coverage of accounts used for government benefits, EBT cards, and the ability for nonprofit researchers to use consumer permission data. We're also going to be working on additional guidance and advisory opinions to advance these goals for open banking and payments. We're also going to be looking for opportunities for other types of financial data, such as those involving investments and securities in people's retirement plans, to plug in easily to this ecosystem. In closing, just steps from where we sit today were the sites of major experiments in our country's history in setting up a financial system. A few blocks away is the first and second banks of the United States, which sought to ensure that banking was bolstering the economy of the young republic. Later, a few decades after that, a Black servant named Curtis Roberts became the first depositor in the nation's first savings association, the Philadelphia Savings Fund Society, whose offices were around the corner from here. Our history reminds us of how important it is that our banking system advance public purposes without entrenching too much power in the hands of a few. We know that a banking system structured to solely support commercial enterprise or only the wealthiest families would lack legitimacy and would fail to provide opportunity to most of our people. Instead of concentrating power with one or just a few giant players with distant outposts from where decisions were made, we promoted a system that served individuals and communities in ways that gave them control. For the U.S. to ensure that our financial system is advancing opportunities in the digital age, for households, businesses, and the economy, our policies must create more power for individuals to avoid being captive and instead exercise their liberty to do business with whom they choose. The CFPB's rule today is an important step toward reclaiming this history. Thank you so much.